America just crossed 40 trillion in national debt. At the same time, interest rates are staying higher than a lot of people expected. The conflict with Iran is keeping pressure on global energy markets. Artificial intelligence companies are borrowing hundreds of billions of dollars to build the next generation of infrastructure, and all of them are looking for money. So today, I want to ask a much bigger question. Is America running out of cheap money? And if it is, what happens next? Because somehow the national debt, the bond market, Iran, oil, artificial intelligence, and your mortgage payment are all connected. I know that sounds like a stretch. It isn't. I'm Kyle Grimshaw, and this is the Texas Market Brief. Good afternoon, everyone, and welcome back. I'm Kyle Grimshaw with the Grimshaw Home Group. Today is Monday, August 24th, 2026, and I'm going to give you a warning before we get started. You're in for a longer ride today. We're going pretty deep, and we're going to talk about the national debt, interest rates, the bond market, the war with Iran, oil, inflation, the US dollar, and artificial intelligence. And right now, you might be wondering, Kyle, what in the world do any of these things have to do with each other? Everything. So stay with me. We're going to build this one piece at a time. And I promise, by the end of today's episode, this is all going to make sense. So let's jump on in. Let's start with a number that should probably be getting a lot more attention. $40 trillion. According to Treasury data, total public debt outstanding across 40.47 trillion on August 18th, 2026, according to Treasury fiscal data. Now, a number that large almost becomes meaningless. $1 million, we understand that. A billion comes a little harder. A trillion, at some point, we're basically just adding commas. So instead of focusing only on the size of the debt, I think there's a better question. What does it cost us to carry it? Because the United States doesn't have $40 trillion sitting on a credit card somewhere. The government finances itself by selling debt. Treasury bills, treasury notes, treasury bonds. Basically, investors lend money to the United States government, and the government promises to pay them back with interest. For decades, America benefited from being able to borrow enormous amounts of money relatively cheap. The dollar is the world's dominant reserve currency, and US Treasury securities have traditionally been viewed as some of the safest financial assets on earth. That meant investors around the world were willing to lend America money. But something important is changing. Investors are demanding more interest to do it. The 30-year Treasury yield recently moved above 5% and touched 5.327%, the highest level since 2007, according to Reuters. And suddenly, the price of carrying $40 trillion in debt becomes a much bigger problem because CBO projects federal net interest costs will rise over $1 trillion in 2026, according to the Congressional Budget Office. Think about that. The own office of Congress is attributing more than $1 trillion to paying down the debt. Not building a bridge, not building a school, not cutting your taxes, not funding some brand new program, just interest. The cost of money we already borrowed. And here's where this gets uncomfortable. The government still needs more money. We're still running deficits, old debt keeps maturing, and has to be refinanced. New spending has to be financed, which means Washington keeps going back to the bond market and asking, anybody want to lend us some money? Anybody want to give us more money? And that brings us to something most Americans rarely think about. Who actually owns America's debt? You'll sometimes hear people say, China owns America. No, that's not really how this works. Foreign governments and foreign investors absolutely own a meaningful amount of US Treasury securities. Japan is still one of the largest foreign holders. China still owns a substantial amount, but most publicly held US debt is not sitting in one foreign government's hands. A huge amount is held domestically. Banks, pension funds, mutual funds, insurance companies, the Federal Reserve, American investors. So, when we're talking about the Treasury market, we're talking about one of the largest financial markets on earth. And here's where things get interesting. Investors have choices, okay? If you're going to lend the United States government money for 30 years, you have to decide, what is that worth for me? If inflation is higher, you probably demand more interest. If you're worried about deficits, you may demand more interest. If you think there are better opportunities elsewhere, AI, then you may demand more interest. And when there's enough investors making that calculation, bond yields rise. That's why market's saying, if you want my money, you're going to have to pay me more for it. And this week, we got another reminder that the Treasury market is still under pressure. Treasury doubled the size of some 10 to 30 year buyback operations to at least $4 billion after long bond yields surged. Yields initially eased and then started climbing again, according to Reuters magazine. The bond market's message was basically this: we're still not convinced. And if Washington has to pay investors more, that doesn't stay in Washington. Eventually, it reaches you, the taxpayers. This is where a Washington story becomes a Texas housing story. The Federal Reserve controls short-term interest rates. It does not directly control your 30-year mortgage. Mortgage rates are influenced heavily by the long end of the bond market, including Treasury yields, inflation expectations, and the extra return investors demand for holding mortgage-backed securities instead of treasuries. So, when long-term yields rise, borrowing throughout the economy tends to become more expensive. Mortgages, corporate debt, commercial real estate, business loans, government borrowing, everything is operating at a higher baseline cost of money. And now, the Federal Reserve has another problem: inflation. If the economy weakens, the Fed would normally like the flexibility to lower interest rates. Lower rates make borrowing cheaper. That can stimulate housing, business investment, hiring, consumer spending. But if inflation remains elevated, the Fed has less room to do that, because cutting too aggressively could reignite inflation. So now Washington has an uncomfortable combination: huge borrowing needs, higher interest costs, and a Federal Reserve that cannot necessarily make money dramatically cheaper without creating another problem. And that's not theoretical. As of August 20th, Freddie Mac says the average 30-year fixed mortgage is 6.65%, and the average 15-year fixed mortgage is 5.95%. That's why this matters. The housing market is not just waiting on the Fed, okay? It's reacting to the broader price of money. And that's where something happening thousands of miles away enters into the story. Now we're going to Iran. And before I go any further, I want to separate what we know from what I think, because I have real questions about how we got here. President Trump campaigned heavily on ending wars and avoiding new ones. But the United States is now involved in a conflict with Iran that increasingly risks becoming exactly what a lot of Americans promised we would avoid: another prolonged conflict in the Middle East. And regardless of whether you support Trump, Netanyahu, Israel, Iran, or none of the above, the economic consequences do not care about your politics. The Strait of Hormuz remains one of the biggest parts of this story. A significant share of the world's oil still moves through that narrow shipping lane. So when shipping gets disrupted or markets start worrying that it could, oil reacts. And oil does not wait for politicians to agree on what's happening. The conflict has continued creating uncertainty around shipping, energy exports, sanctions, and whether any lasting diplomatic solution is really within reach. And oil prices have responded accordingly. Now ask yourself, what happens if this continues for another 6 months or a year? Oil stays expensive, shipping stays expensive, fuel stays expensive, transportation costs increase. Businesses absorb some of that and pass some of it on to the consumers. Inflation becomes harder to eliminate, And if inflation stays elevated, the Federal Reserve has less room to lower interest rates. And now we're right back to where we started. War affects energy. Energy affects inflation. Inflation affects interest rates. And interest rates influence Treasury yields. Treasury yields affect what Washington pays to finance $40 trillion in debt. And those same financial conditions affect what you pay to borrow money. That's the chain reaction. But while I was looking into all of this, I started thinking about something else. And this is where we're going to get a little controversial. War actually saved the US dollar. Stay with me here. There's an argument I've been thinking about, and I want to be extremely clear before I explain it. I am asking a question. I am not telling you I uncovered some secret government plan. I'm not presenting this as an established fact. I'm following incentives. Because there is a theory in economics and geopolitics that periods of instability can increase demand for the US dollar. Why? Because historically, when the world gets scared, investors look for safety, a safe place to put their money. And one of the places they've historically gone is the United States. US dollars, Treasury securities, dollar-denominated assets. That's the classic safe haven trade. So I started asking myself, at a moment when Washington desperately needs investors willing to finance enormous amounts of debt, could geopolitical instability actually help maintain demand for dollars and Treasury securities? It's an interesting theory, but there's a problem. The evidence does not fit that theory neatly because this particular war also puts upward pressure on energy prices. Higher energy prices can create more inflation. More inflation can make investors demand higher yields. Higher yields make America's debt more expensive to service. So, if the argument is the United States entered this war to save the US dollar, I cannot prove that. And based on the financial effects we're seeing, I'm not convinced the evidence gets us there. At least not right now. But here's what I do believe deserves scrutiny. War, oil, the dollar, Treasury demand, federal debt, interest rates. They are not separate systems. They are all connected. And governments do not operate independently from financial markets. Eventually, someone has to finance the decisions governments make, which brings us to the twist in today's story. Because Washington isn't the only one looking for enormous amounts of money. Washington isn't the only one looking for money. Big tech is too. Remember everything we've been talking about over the last several episodes? AI data centers, semiconductors, power plants, natural gas, nuclear, transmission, servers, cooling, construction, land. All of that AI infrastructure we've been talking about, so yeah, somebody has to pay for it. And now the bill is arriving. Reuters reports that US AI-related corporate debt issuance has reached roughly $220 billion in 2026. Last year, roughly $12.5 billion. That is a huge increase. And investors are starting to show signs of fatigue because suddenly everybody wants money. Washington needs enormous amounts of capital. Big tech needs enormous amounts of capital too. Other governments need capital. Businesses need capital. Consumers need capital. And investors have choices. So here's where I want you to get involved. This isn't the question of the day. I just want your prediction. Who gets financed first? Washington or big tech? Imagine you're managing billions of dollars. Do you lend that money to the United States government? Or do you lend it to Microsoft, Google, Amazon, Meta, or one of the companies building the AI economy? Government or big tech? Put your prediction in the comments because I think we're about to learn something very important about how deep the world's appetite for debt really is. Now, there's an important clarification. It's not literally one or the other. Investors can own both. Treasuries and corporate bonds serve different purposes with different risk profiles. But when governments and corporations simultaneously need enormous amounts of capital, investors can demand better returns. And that means the price of money goes up, which brings us to the final piece of today's episode. What if cheap money doesn't come back? For more than a decade after the financial crisis, America got used to cheap money. Cheap mortgages, cheap corporate debt, cheap government borrowing, cheap capital for technology companies. Money was inexpensive, and that was a changed behavior. Consumers borrowed, companies borrowed, governments borrowed. Investors took more risk. Asset prices climbed. Technology companies could raise enormous amounts of capital. Now, imagine the opposite. What if 5% long-term Treasury yields are not temporary? What if mortgage rates don't return to 3%? What if Washington has to refinance trillions of dollars of debt at substantially higher rates? And what if AI companies discover that investors are not willing to finance every data center at any price? Something has to adjust. Maybe government spending slows. Maybe taxes rise. Maybe companies cut investment. Maybe asset prices reprice. Maybe hiring slows. Maybe consumers spend less. And yes, if enough of those things happen together, you can create recessionary pressure. But I want to be careful here. America crossing $40 trillion in debt does not automatically mean we are headed into a recession. That's not how economics work. Deficit spending can support growth in the short term. The real danger is the combination we're talking about: high debt, persistent deficits, expensive interest, sticky inflation, higher energy prices, higher bond yields, and enormous private sector demand for capital, all happening at the same time. This is when the room for error starts getting smaller. And that's where the part is I think needs more attention, because maybe we've been asking the wrong question. Everybody keeps asking, when is the Fed finally going to cut rates? Maybe the better question is, what if cheap money isn't coming back? Remember what I told you at the beginning? Stay with me, and eventually this would all make sense. Well, look at where we just went. We started with $40 trillion. Then we went to the bond market, then interest rates, then Iran, then oil, inflation, the dollar, then artificial intelligence. And somehow we ended up right back at your mortgage payment. That's the point. The economy is not a collection of headlines, it's a system. And when you push one part of that system, something moves somewhere else. Government spending is not free. War is not economically isolated. Artificial intelligence is not just software. And interest rates are not just some number the Federal Reserve announces every couple of months. They are all connected. And right now, America is trying to finance enormous ambitions. At the same time, we're carrying enormous obligations. We want to finance the government. We want to rebuild manufacturing. We want to dominate artificial intelligence. We want to build power plants. We want to strengthen the military. We want affordable housing. We want lower taxes. We want lower interest rates. And we want to keep spending. At some point, the math has to matter. And I don't think that means America collapses tomorrow. I don't think $40 trillion is some magical number where everything suddenly breaks. But I do think it means the decisions get harder. Because when money is cheap, you can hide a lot of bad decisions. When money gets expensive, eventually someone gets the bill. And that's what I want to leave with you today. If getting America's national debt under control eventually requires sacrifice, what should Washington sacrifice first? Should we cut government spending, raise taxes, reform Social Security, Medicare, or other entitlement programs, reduce defense spending, or should America focus primarily on growing the economy fast enough that the debt becomes more manageable relative to the size of the economy? And maybe your answer is something completely different. Tell me in the comments, because this is not really a Republican question and it's not really a Democrat question either. It's a math question, and eventually somebody has to answer it. Leave your thoughts in the comments. I'm genuinely interested to see where everyone lands on this one. And if you made it all the way through today's episode, hooray. Thank you very much. I warned you this was a very long episode. You were going to be in for a longer ride, but these are exactly the conversations I want us having on this channel. Not just what happened today, but why did it happen? What does it connect to? And most importantly, how could it eventually affect you? If you found today's episode helpful, make sure to subscribe and share this one with somebody who likes going a little bit deeper than the headline. I'm Kyle Grimshaw with the Grimshaw Home Group. Thank you again for joining me for another episode of the Texas Market Brief. I hope you have a great week. Until next time, stay informed, stay curious, and remember, the best decisions are made by the people who understand where the world is headed.